Hello and welcome back to InterTax Learning. If you work with foreign individuals or foreign businesses, there's one question that determines almost everything about U.S. tax exposure. When does the U.S. get to tax foreign income? The answer usually comes down to one concept. ECI stands for Effectively Connected Income. It is income that is connected to a U.S. trade or business. The net basis of that income is taxed at graduated rates for individuals and a fixed rate for corporations. ECI is a concept that's important for foreign taxpayers. U.S. residents are already taxed on their worldwide income, including those income that's not connected to a U.S. trade or business. To determine whether an income is a U.S. ECI, we always start with two questions. One, is the foreign person engaged in a U.S. trade or business? Two, is the income effectively connected to that business? Let's tackle each one. Generally, a foreign person is engaged in U.S. trade or business if they conduct regular, continuous, and considerable business activities in the U.S. Common examples include running an office, store, or warehouse in the U.S., having employees or agents regularly performing work in the U.S., providing services physically performed in the U.S., or producing goods in the U.S. Now, there's an important distinction between dependent agent and independent agents. A dependent agent is basically an employee who can create a U.S. trade or business. An independent agent who files a 1099 generally cannot create a U.S. trade or business. Independent agents often work for multiple companies and are paid per project or based on commission. They do not solely represent one company. Once we determine that a U.S. trade or business exists, we then apply two main tests to determine whether income is effectively connected. Income is ECI if it comes from assets used in the U.S. trade or business. For instance, a foreign company has a U.S. factory. The factory produces goods and earns sales income from selling those goods to U.S. customers. That income is U.S. ECI. Income is also ECI if it is mainly derived from U.S. trade or business activities. For example, a foreign consulting firm sends its staff to the U.S. to perform service. Fees from those services are U.S. ECI. ECI is taxed on a net basis, which is an advantage. Taxpayers are able to deduct expenses conducted to that ECI, such as operating costs, property expenses, COGS, allocated expenses, interest expenses, etc. You may not think this as an advantage because the taxpayer still has to remit tax. However, if you think about a foreign individual with a U.S. rental property, when the rental income is treated as a passive income and not an ECI, the foreign individual is subject to a withholding of 30%. That's the default percentage on the gross rental income. If the rental income is treated as an ECI, that taxpayer could reduce it by any expense incurred by the rental property and be subject to a lower tax. We'll talk about how passive income is taxed in the US in a later video. Going back to our rental property example, the net basis is clearly a benefit. If taxpayer has ECI, then a Form 1040-NR or Form 1120-F must be filed on an annual basis. Tax rates vary depending on the taxpayer status. For foreign individuals, graduated rates range from 10% to 37%. For foreign corporations, a fixed rate of 21% is applied, just like U.S. corporations. To summarize, ECI determines whether they can tax a foreign person, how much tax they pay, and whether they must file U.S. tax returns. Alright, that's it for this video. In the next video, we'll discuss FDAP, fixed, determinable, annual, or periodical income, and how a foreign person's FDAP is taxed in the U.S. I welcome your comments on these topics. Subscribe if you'd like to learn more about international tax.